been in this space, I think, for varying lengths of time. So perhaps to start with you, Debra, and the foundation side of things. I think MacArthur has been in this space for 30 years or so. How do you see demand changing? How's it affecting what you're doing?
Thanks, Andrew. It's great to be here, and thank you to Matthew and others at The Economist for putting together a really wonderful gathering. Audrey is so on top of some of the statistics that I think I will let her share some of the things that they've gathered through research at Morgan Stanley. I'll speak for the foundation part of the impact investing world, and we have been doing this since 1986. We've allocated $500 million, 100% of that $500 million to very high impact debt equity investments, as well as guarantees and the like. We've seen in the philanthropy part of the world, certainly some big change. And I have personally been involved in this work for over 15 years. There are many, many more family foundations today than we saw even 5 or 6 years ago. We're seeing donor-advised funds get interested, and I can share later something that we've done to try to help capitalize on that. But donor-advised funds are showing up and are coming to impact investing gatherings like this and want to look at a way to create product for their donors. We're seeing many more family offices, and I would say probably I'm kind of tied between seeing the family offices and the family foundations. They're kind of, in a sense, two sides of a coin. But many family offices that don't use a foundation but are very, very serious about their work. And we have new networks like The Impact, which is a network of families that are dedicated. Tonic is another network of families and individuals that are dedicated to impact investing. So what it means for us is that we have many more folks that we can partner with and co-invest with, and who we can help and help create on-ramps so that they can participate in the market. We've long collaborated with financial institutions, Morgan Stanley included. We've collaborated with insurance companies, but this huge array of individuals and families, I think this is very new.
Does that change the way you have to think about the money that you bring to the table? So whereas before you would have been crowding people in, do you have to start thinking about crowding out, or is it too early for that?
Oh, I think we have an even bigger job of crowding in than we've ever had, because it is difficult if you are an individual or a family and you don't have a team of people and you want to do, let's say, the kind of impact investing that we do, which is really in the deep end. It is deeply purposeful investing. It's taking risks on first-time fund managers. You had Nancy up here earlier. We made a program-related investment to help launch what became DBL. And in another fund, a Sustainable Jobs Fund that's now well established, we can often play the role of paving the way, creating things that become investable for others, either by going first or often by providing guarantees or wrapping an investment opportunity so that it can be workable for a more mainstream investor.
Okay, terrific. Audrey, but same question to you on the institutional side. And I have Andy Cooper's words sort of ringing in the ear. I'm not sure if you heard him saying it's not enough to put 5 people into the sort of the impact space in the institutional world. So how meaningful is this? How have things changed in the 5 years since the Institute started?
Yeah, well, I mean, we've definitely seen a dramatic shift in the overall field and really, frankly, the momentum. I mean, we actually, Morgan Stanley, we started the Global Sustainable Finance Group about 9, almost 10 years ago, and really with the belief that financial markets and private sector capital had to play a critical role in addressing some of these major problems that we're facing as a global society, whether that be climate or resource scarcity, education, health, housing. And at the time when we launched that 10 years ago, people said, well, that's curious. You know, why is Morgan Stanley doing that? That must be an act of sort of commitment of responsibility or something sort of not quite core business. And I think what people have increasingly understood as we've done this, so 5 years ago, as you said, we launched the first integrated multi-platform product suite for our clients to be able to invest as part of their traditional portfolios. So not their foundation money, not their concessionary portfolio, not their sort of play money to the extent that someone has that, but really just their core bread and butter portfolios. But again, even I think 5 years ago when we did that, there were still people saying, oh, that's quite interesting that Morgan Stanley has come into this space that has traditionally been pioneered by the likes of foundations and philanthropists. What is that about? And I think ever since, we've always said we fundamentally believe that sustainability and having a social impact is not something that is somehow separate from and optional to how business functions, right? As business functions, you are affecting the communities that you live in, the employees that you employ, the products that you create, and the environment. And so that has to be regarded not just as some optional side externality, but a core part of business. And so we've really spent a lot of time thinking, we believe that that is actually part of business, and that the companies and investment options that do that in the best possible way really do have returns that accrue to their business from a profitability perspective. And so that's what we've tried to build the investment thesis around. And so what we've said is, absolutely to your point, it's those investors who can spend the time and partner in a very focused way on a high impact investment, potentially in the private equity space or in the entrepreneurship space, is wonderful. And that should continue. And there's this much broader class of people who, really may need to be focusing on public equity, public debt, broadly available instruments that are highly liquid, that are easy to understand, easy to transact in. And that's where we've really focused. And so we now are at the point where we've got more than $6 billion of our clients who have assets under management specifically saying that they want to be integrating environment and social considerations into their fundamental portfolio. We've got more than 130 products from all different providers. And what we've seen there is a real maturing of the industry where more and more asset managers and asset owners are really looking at this. So to really kind of just try to put a bit of a concise answer to your question, thanks to the numbers from US SIF, we've seen that today in the United States, it is now more than 1 out of every $5 into professional management that have some sort of sustainable mandate to it. 1 out of 5 is a lot, just in the absolute, and I haven't yet found a wealth advisor who says I only want to help a client deal with 8 out of their $10 that I could potentially manage for them. But the growth rate is really stunning. If you look at 2012, it was 1 out of every $9. 2014, just 2 years later, was 1 out of every $6, and now 2016 is 1 of every 5. So the U.S. has seen a real steep curve as we sort of catch up to the level I think that Europe has long had of being involved in that. And I think as a sort of a great segue to your next panelist, what I would just say is generationally, we're also seeing a very significant change. When we polled, we did a poll of 1,000 individual investors, and we found that 71% overall said that they were interested in sustainable investing. When you broke that out by demographics, though, it was about 60-some% of men who were interested in it, 76% of women, and 84% of millennials. And obviously, as everyone's very well aware, there's going to be trillions of dollars, changing hands first to women and then to millennials over the next few years. And those two groups are clearly saying they want to integrate their values and their beliefs and their awareness of the broader ecosystem into their investing. And the last thing I'll just say before letting you hand off is on millennials, we found that millennials were 3 times more likely than other generations to choose their job because of sustainability. They were twice as likely to check product packaging to make sure that what they were buying or putting in their body or on their body or for their homes was sustainable. And then unlike other generations who might say, okay, I'll buy organic, but I want to invest traditional and then give away the excess money, millennials were saying that they're twice as likely to look at sustainability as a reason to buy a stock or as a reason to divest. And so we're seeing a real continuity there. And
just before we come to Joshua, how sticky do you think those attitudes are amongst millennials? I mean, why won't they become jaded and cynical like the rest of us?
Right. So look, there's an element to say that certainly, potentially millennials will be like all people and be idealistic in their youth and more, I'll just say traditional in their more advanced years. But a number of anthropologists and sociologists are saying that they are seeing something very fundamentally different about this generation in terms of their belief about their effect on society, their responsibility to what happens in society. And personally, I think that one of the biggest reasons I believe you cannot put this toothpaste back in the tube is the fact that every single one of you has a supercomputer in your pocket right now. I mean, literally, when I worked in the White House 20-some years ago, the amount of computing power that you have in your pocket would not have been allowed to cross, federal borders without a national security clearance. That amount of computing power and transparency means that any college kid sitting under a tree can say, wait, how is my endowment invested in that? And they might be looking at one of, 100 different holdings going down to an individual project held by one of however many private equity funds, which is one of however many, and saying, I don't want that in my college's endowment. University president's office right here, let's go complain or protest or say what we want instead. And that amount of transparency, I think, has really been driving even for individual investors and institutions to say, because we can know, because others can know in an instant, we actually now are accountable in a different way to what we own. And people more and more are saying, you are what you invest. And if you believe in these things or don't believe in these things, why are they in or not in your portfolio?
Okay, terrific. Joshua, let's bring you in at this point. So I think you're going to speak for retail markets, maybe for millennials as well. I'm not sure, but perhaps give people a sense of what OpenInvest is and the opportunity that you see in terms of mainstreaming of impact.
You changed the question on me last minute.
It's the same question. It's slightly altered.
You're a millennial, you can roll with the punches, right?
Yeah, but we're addressing exactly these trends that you've been talking about. And I think if you want to understand where the market's going, you should also just look out your window. It's the Women's March. It's Black Lives Matter. It's the Dakota Access Pipeline. I mean, protest is the new brunch. This is going on all around us. You have to be blind if you don't see it. And if you want to grow your business and we want to grow impact investing, which set of motivations do you want to tap into? Guilting yourself once a year to check a box on, when you redo your finances? Or to become a channel for people's anger and for their desire for impact and to drive change? That's where the market's going, and that's how we brought in the space. And so OpenInvest is, on the surface, it's the first robo-advisor, online advisor for socially responsible investing. But we actually control and manage the underlying assets in a new way, leveraging recent technologies in order to give tools to the public, to give public markets back to the public so that anyone can fully customize their portfolio to what they care about. They can take actions in real time in response to events, corporate scandals, create campaigns, participate in campaigns, vote in their shareholder resolutions, see everything they own, account for their impact in real time on their dashboards as well as their financial performance. This is the way that we change the psychology about what finance really is. It's actually one of your most powerful ways to shape the world. If you're out picking at the airport on Sunday, you don't want to know that you have thousands of dollars in energy transfer partners or in Trump's companies or whatever it is that you care about. And yeah, we have information and we can see that now. And once we give public markets back to the public, which is how the public is going to engage in this space, right? They're not accredited investors. This just opens the door wide open for impact investing. So even this year, we're going to start slotting out pieces of the portfolio with community notes, green munis, and other impact products, but it needs to fit in with a coherent, diversified portfolio. And these are some of the ways that we think that the public is going to transition into this space and really broaden the pie.
What are the roadblocks to the sort of mass adoption of both your product, but more generally these kinds of investment products?
Well, here, you want to know the roadblocks? Let's be honest. So you guys are some of the most passionate people in the world about impact investing. You paid to be here, right? So if you're not going to do it, no one else is going to do it. So let me see a show of hands of how many of you in your personal retirement accounts, your equities, your fixed income are 100% impact.
Pretty good.
Okay, great. So then, and don't make me cold call. Just shout off, a few of you, just shout off quickly, what are some of the reasons that you haven't done this? No, don't be bashful. 95% of you haven't done this, so you're among friends. Lack of product?
403B restrictions.
Okay, thanks.
Yeah, 401k restrictions.
Mm-hmm.
Knowledge for the financial advisor.
Mm-hmm. Yep. So 3 out of 4 of those were intermediaries, right? So if we know, we have these stats now, thanks to Morgan Stanley, 70% of individual investors want to align their investments with their values. And there are a lot, I think we know, because you're selling them, there's a lot of products, right? So what is the blockage? It's intermediaries. In public equities, most of their jobs can be done by computers now. So at least our approach is we need to disintermediate the finances from these intermediaries and actually give people direct ownership once again, of their finances and what they own. And this is where we unlock all this power and dynamism and customization that aligns with both millennials and just frankly anyone who cares about stuff and wants to know where their money is going.
I'd like to have both Audrey and Debra come back on this and sort of react to that, because there are some sort of tensions here, right, with the idea of impact as it originally was. So Joshua's sort of describing a world where we're sort of screening in a way. It's more the sort of sustainability screening, less deep impact, if you like. So for people who kind of are more on that end of the spectrum, how do you react to what you've heard? Perhaps Debra first and then Audrey.
So I don't think it's an either or proposition. I think it's a both and, because in fact, intermediaries do have a significant role to play in impact investing, especially where you have projects or organizations that are quite small. And if we can pool them up, you can start to make them investable, whether that's investable through an online platform, through a private wealth platform, or in some cases, we are actually turning ourselves as a foundation into intermediary. We have an initiative called Benefit Chicago, which we launched last year. And for the first time, we've set up a managed fund that through an agreement, my team is staffing to do very high touch and therefore high cost kinds of transactions, but with things like an urban farm, a guy who's got a business doing really cool things with tablets to create educational experiences that are high quality for people who are incarcerated. Other kinds of things like a business that employs ex-offenders. These are things that are not going to fit in a cookie cutter, and it's difficult to underwrite. We have 30 years of experience doing that. We can package that up in our fund, and then through the Calvert Foundation community note, there can be a simple way to participate. But we're also doing some things that are more in the direction that Josh was talking about. We've provided startup funding to something called Impact Us, which would be an online broker-dealer where enterprises could go and list their offerings and become more directly accessible to investors. So we don't see it as a stark choice. I want to also say I think the Benefit Chicago experience has revealed another really important trend that we're seeing in the market, and it's one for which the online piece is not going to be wholly sufficient. There is tremendous appetite to invest locally, to invest where people live. That's what sparked, over 100 people fairly quickly to join in and directly invest in Benefit Chicago. And that democratization, opening it up and creating a window so people can come in directly has been very powerful. We've had over 24 cities and regions from across the country contact us over the past year. There's actually been so much interest in comparing notes and talking about how to do this in their own communities that we're making a grant to support a convening of all of those actors. I think that when community foundations want to team up with others and create that local impact investing opportunity, it's going to require some kind of party to bring all the pieces together.
Audrey.
Well, I would say that I think we're actually, at this moment in time, we're actually at sort of the confluence of at least 3 major tipping points. One around sort of style, one around data, and one around product. And I'm saying that so I don't forget those 3 to come back to them. In terms of style, we've seen that I think there's been a real shift in focusing on just screening out versus proactively looking for ESG. And so if you look at the flows that we've had, I think, historically, there was initially much more of a focus on sort of, avoiding the sin stocks, or, and over the centuries, frankly, that method of sort of ethical investing has really taken a lot of different shapes. And I think the single biggest thing there that I think where we're seeing more people actually doing it is the fact that we're seeing an increased ability to screen out some of these products that you don't want without a enforced necessary penalty to performance, right? I think that's been the wrap there. People assume if you're going to be an ethical investor, of course it means you're taking a discount on your returns. And we've seen that increasingly that does not have to be the case. And so we actually are seeing more shift of people really saying, I don't want to just screen. I do want to screen potentially, but I also want to really look for the high environmental, social governance, kind of good governance practices. I think in terms of product that we're also seeing to the person who said the lack of product, I think that the good news is I think we're seeing a real shift. We actually at the Institute recently did a poll of asset managers to see what they were thinking about. And it was was really interesting. They said 89% of asset managers said that they were aware of, familiar with ESG. And then 65% of them said that whether or not their firm today was offering any ESG product, that they had plans to offer at least something within the next 12 months. Now, I think the big challenge for us as an industry is that to make sure that those are good products, or that they're really high quality products, both from a financial perspective and from an ESG and impact perspective. But I do think that there is, you are going to, and I think, look, the fact that we've got a room full here and we've got, the Economist here with impact investing without any sort of apologetic, note after the colon is a real signal of the fact that impact investing has sort of become mainstream. And you really can't pick up a Forbes, Fortune, or Economist these days without some article about, gosh, in the last 12 months, here's all the other big financial institutions who've come into this. I think we are at that tipping point where people see there's a lot of people who want to do this. There's not enough product. There's an opportunity to really grow this field. But the last thing that I would say about and the reason that I'm actually optimistic that this is going to become much more than a sleeve of people's investing or sort of a cute little lens on top of people's investing, is that I think that the real game is in how we understand that environmental issues, social issues, and governance issues, frankly, are just a part of core business, right? So my wish and my crystal ball prediction would be that certainly in 10, but hopefully in 5 years, that sustainable investing becomes a bit of a redundant term. With the work of organizations like the Sustainable Accounting Standards Board, which is really focusing on sustainability being understood as a core part of whether a business is functioning and operating at its best or not. With things like the Financial Stability Board saying that you are actually being irresponsible from a risk perspective if you don't understand how climate change risk can affect your business. As more and more of these things actually get integrated into the mainstream, it's going to be the point where, again, if someone came to you and said, so there's this, pretend you were a few years back, right? And someone came to you and said, Debra, I've got 2 investment portfolios that you can choose from today. Would you like the one that doesn't look at political risk, because that's the sort of newfangled risk factor that we've just started thinking about, or do you want the one that, that includes political risk into the calculations of where to invest? You'd say, well, I'm crazy to not want the one that has more data informing what could be an upside or downside. And so I think that we're getting to the tipping point where people are starting to understand that understanding sustainability, thinking about environmental issues, thinking about impact, that's not taking your eye off the ball. That's actually just widening the lens so that you're not kind of being tunnel vision and saying, I'm only going to look at what's on today's balance sheet. So that's where I think we're ultimately going to go, that this transparency is going to mean if there's data out there that says you are a better environmental player and steward than your competition, why wouldn't we want you? And the last bit of data that shows, we actually, our partners in equity research looked at gender diversity. And because I think I think all of us, or most of us, tend to believe that gender equity is a good thing, right? And so of course you'd want gender equity to be a hallmark of companies that you think are good companies. But are the results really there? So our team, the sustainability team within research, teamed up with the quant team, and they actually looked at a whole host of factors that would be hallmarks for whether a company is doing a good job or less good on gender equity. And what they found was not just the high gender equity companies were nicer or won more working women awards. What they found was that the ROE was higher, the volatility was lower, and that they moderately outperformed their peers.
Okay.
My name is Philip Ellison. I'm from California, a Grapevine development company. And that actually is where my question comes from. A lot of the context that we've been talking about impact investment has been really the global context. We're talking about sustainability on climate change and other related issues. However, I think if we look at the last election, I think what we have seen, and the important lesson is that within our borders, within this country, there are vast areas where there are tremendous needs because of structural dislocations in the way the economy works, the way manufacturing jobs have gone away, the way the education system is failing us. A lot of things that have created real need within this country. And Debra, you talked about your portfolio and the high number of dollars that are going into various investments. Also, you mentioned the program in Chicago. I'm wondering, maybe among all of you, how much of what you're looking at in terms of investment, and Josh, with your company, how much actually is focused on domestic needs? And again, those needs are part of the impact we're looking at. Again, whether or not in the communities we deal with in California, our needs are for housing.
Right.
They are for retail mixed-use facilities. They are for transportation facilities. A lot of things in low-income Latino communities where I come from that have very little to do with UN standards and all that kind of stuff. So that's, to me, a real priority because of where I come from. But I wonder if that message should be something that we all think about when we think about our portfolios. And yes, the globe and the world it's one world, but we have, again, within our borders, huge challenges.
You didn't say America first, so well done. No. We'll go for Debra Schwartz, and then Joshua. Perhaps to you, and Audrey. We'll wait for the next question.
So I think it's a great point, because one of the things that's a challenge about creating this big tent of impact investing is not just the different kinds of investors who often collaborate and play different roles in the ecosystem, but it's how can we be more inclusive in terms of the kinds of things that we think of as impact investments. And I can tell you, there's a very large field that we've helped build over the decades alongside with the Ford Foundation, and that's the field of community development finance in the United States. It actually got started and was the inspiration for some of the early microcredit pioneers. And that field is alive and strong today and working often in some of these really, really difficult markets. Southern Appalachia, the Mississippi Delta, working with migrants in California. And they're not well enough understood and seen within this kind of elite world of impact investing, but that is the on-the-ground hardcore stuff that we've funded for decades. We're working on ways to create vehicles so that other investors can participate. Affordable housing is another really incredible one, and we've put more than $200 million into preserving affordable rental housing across the country in urban and rural settings by investing in a set of leading nonprofits that are social enterprises, even if in our lexicon, we don't think of a nonprofit as a social enterprise.
I should just simply say that, to be clear, that our company is a for-profit company. We are looking at, but we have standards, prevailing wage, union labor, a lot of things that connect with our sustainability profile. But my point is that these are investment opportunities for people that we're not a charity. Yet we have charitable views about many things,
right.
But we are not a nonprofit.
I think I'll just end with one example in the housing space that sits kind of right where you're talking about. It's an organization called the Housing Partnership Equity Trust, and is the only nonprofit-sponsored REIT in the United States. There is one other REIT that also is dedicated to affordable housing. The type of housing they're doing is not the deeply subsidized kind. It is really preserving workforce housing in key locations in markets where there may not be much rental supply. That enterprise is set up to generate a good return. It might not be matched to the REITs that flip properties, but it's a good return, a solid return, solid players involved. We helped launch with an equity investment that was highly concessionary. Today, Morgan Stanley is an equity investor in that REIT. We provided a liquidity backstop to help Morgan Stanley and Citibank come in that position, and we believe this will grow to $1 billion social enterprise here in the United States.
Joshua, to you too, the need to focus on the domestic.
So to start, I'll politely disagree with an earlier comment from Debra, which is that we actually know, or can know through technology, the exact geography and location
I wasn't saying you don't know it. I was saying it's hard to do it. It's hard to do highly locally focused investing.
Yeah. So I was just banking off to make comments. So the investor, they should get an alert when they're walking by a community housing project that they've invested in.
I love that.
And frankly, this space right now, we're in the early stages. It's like back in the day, people building PCs in their garages. There's all these fragmented pockets forming around Calvert Community Notes, Kiva, what have you. But right now, if you buy one of these things, what does it mean for your diversification? Are you overweight your local community, solar, grapevines, Indonesia? You have no idea. It's basically a write-off. And
why do you say it's a write-off?
Because you can't actually integrate it effectively into your portfolio. So I don't know at the institutional level, but for retail investors, they're treating this as a fun or engaging or side project, but it's not what they're planning to retire on because they don't know what it means for the overall balance of their portfolio.
The only reason I ask is because MacArthur Foundation, who's something that it's an institution we helped create and we're partnering with. In their entire history, there has never been an investor that has lost their principal.
Oh, so it doesn't mean, I don't mean that they're losing their principal.
So when you use write-off, that's
Sorry. Yeah, no, thank you. But the space so far, we've failed to tap in to the main artery of American capitalism, which is the American retirement savings. And that's when I think this goes from niche to mainstream. And the retail investor of the future, we believe that they're going to have the same performance and diversification of their parents, but they're going to see and feel how they're interacting with their communities and the world every day. That's where it's going. And the local, I think it's technology that will really empower and enable that local engagement and make it work within the portfolio that meets their long-term financial needs.
We have a question from the app, which is about the tax implications of transitioning a portfolio to an impact portfolio. Audrey, I don't know if you want to take a crack at this one. What are the tax implications and how do you minimize the hit?
So I am not a tax advisor, so do not take any tax management advice from me. I would just say I think that we would never advise that someone overnight flips their whole portfolio for any purpose, right? Whether that be all over, hard over onto impact or tax optimization, whatever else it is. And so I think that I don't know that there would be there's no specific tax friction associated with an impact-oriented portfolio specifically, other than that as you transition portfolio with any kind of shift that you want to be doing that in a thoughtful way. And again, I think what we're really, when we talk with clients who are interested in making the shift, we very much are talking about how do you do this in an orderly fashion, right? Because you do want to be preserving diversification. You want to be preserving your retirement. The goal is that people are not taking some anomalous hit because of this, but that they're being very thoughtful about across my portfolio, where are the areas where I want to be intentionally very high impact and maybe have something that is more locally tailored or tailored to a specific impact area, and where do I want to have sort of broad diversification and still know that I'm aligned with my values and able to sleep at night.
Can I just bank off this too? They told me to be controversial. That's why I'm up here. You're like, why is this guy up here? I paid for this. Every investment has impact. No one can tell me that the largest companies in the world that are employing hundreds of thousands of people, moving goods and services all over, providing the products to you and your children every day, that they don't have an impact. You can either have a really big impact in a small company or a small impact in a very large company or a small slice of a large company. And in the past, back in the day, it was rich industrialists that invested and they knew exactly what they owned. I own that factory and I can tell them to do whatever they want. I want you to make shoes, shirts, pollute the river, don't pollute the river. And it never made sense to aggregate the views. Now that we have diversification, capital markets, it didn't make sense to aggregate the views of all these shareholders. So you handed off these intermediaries and it feels like this is, I don't have any impact. This is the boring stuff where I get diversification. But we have the tools now to actually reconcile all those views. So I believe in the future, all the shareholders of Chevron will be having a real-time conversation about what their company is doing and should be doing. And so it's kind of a return to first principles investing, but this time we'll be doing it together. And the impact will be massive.
Hi. So my name's Temple Fennell. We're actually a single-family office. We're in the oil and gas space. We have 2 public companies. And my question is about how much work, and this is really primarily focused to Audrey, how much work do you put in creating demand? And what I mean by that is we are early investors in generation investment management. David Blood put forth this idea that fossil fuel reserves could be written down, which was heretical in our view. And we're like, you're absolutely out of your mind. And the more and more we started thinking about it, we realized, wow, we actually do have a tremendous amount of exposure to our wealth. So when we started really believing in the stranded asset risks that our wealth had when we're looking 10, 15 years out. So we divested out of some of the family stock. We couldn't really short it. We couldn't really divest out of it. And we built a very large portfolio of renewable wind and solar. And I also helped found a program at Harvard with the World Economic Forum's training next gens. It's called Impact Investing for the Next Gens. And it's a 6-month program. And with some of these next gens, I basically walk in and say, listen, there's 5 words you don't ever use with your CIO. Clean, renewable, climate, basically every word that we're talking about here. Those words are absolutely toxic. This is about long-term investing. It's about risk management. Mm-hmm. And you can really start scaring CIOs when you start outlining some of the stranded asset risks that they have from energy, from food, from agricultural practices. It could be craft supply chain. It could be many, many different types of risks in their public equities. And that can actually stimulate demand. But I don't see the private wealth managers and the advisors stimulating demand by really driving home the stranded asset argument.
I would say that you've hit on so many rich and great points there. We aren't necessarily specifically trying to create demand in that way as much as really trying to kind of increase people's awareness of it. And I think you're exactly right that we feel like the best way to probably move serious dollars is to talk about these issues not from a kind of ethics-based or ideals-based way, but as you said, from a risk perspective, you are an irresponsible investor if you don't want to have all the data you possibly could on things that could be material to your company's performance. Again, the Sustainable Accounting Standards Board did a survey, and they said that something like, I believe, and Dan or Erica maybe will correct me if I get the number wrong, but it's something like 93% of the value of the U.S. equity market stands to be impacted by climate change. And yet probably something like less than 20% of companies actually are reflecting that in their disclosures and their business planning. And that's a huge risk management gap, right? And so what we're trying to do, again, with the partners in the field like SASB and others, is really saying this is data that you need to know as a responsible investor, not a ethically responsible investor, but as a responsible investment professional. And I think that whether that's going to be, are you resilient to the shocks that are going to come from climate change? Are you thinking sufficiently about how we make sure that, companies in the United States are doing the right thing for American workers and for the welfare and well-being and economic well-being of American workers and American communities, as well as to their ROE, is critically important. We've been doing a lot of work with the sort of movement around long-termism, right? Where I think one of the great statistics that came out there was that 70 to 90% of the value of a company is from projects that are probably 3 years or more out in terms of the actual cash flows back to the company. And yet when surveyed, and CFOs were asked, would you invest in a positive ROE project if it could make you miss the street's guesstimate of your quarterly earnings by a penny? 55% of CFOs said no. So we have this real fundamental, anomaly in our system where, a lot of things are geared around sort of short-term analysis that is often very contrary to what we know is long-term. One of the things that we do, frankly, a lot of though is, from the sort of what we might call sort of building the field or kind of raising awareness, and I think you're calling kind of creating demand, is getting people to understand that these are not issues for our grandchildren. Right? These are issues for us, for today, for now. It might not be the next 13 weeks, but it might, right? I mean, there may be something that's been brewing and will show up in the next 13 weeks. So we're focusing a lot on saying, look, this stuff is not off balance sheet. This stuff is not extra financial. It's core to, are you being a really shrewd investor and understanding your risks and your upsides?
I'm Catherine Howarth from Share Action. So thanks for a great panel, very encouraging. Audrey, you've just laid out the most fantastic, compelling, and to my mind, convincing case for why there's just a really strong business case for all of this. Mm-hmm. And right above your head, it says mainstreaming purpose-driven finance. Uh-huh. How is this thinking getting mainstreamed into Morgan Stanley Asset Management as a whole, mm-hmm. and all the rest of the mainstream asset management companies? Because that's, of course, where most working people have exposure through their 401ks or their retirement plans or whatever. They don't have access to this impact investing space. So if this is a compelling logic, which I think it is, many of us in the room agree, how is that going to be something that transfers into the mainstream for the benefit of everyone who should benefit from it?
Thank you. That's absolutely what we're really focused on, which is that at Morgan Stanley, we're focused on the Institute for Sustainable Investing not being sort of a niche boutique that does its own cool deals, but actually working with the firm broadly. And so I'll just give maybe two quick examples because I know we're running short on time. But within wealth management, what we've done is instead of creating just one or two Morgan Stanley products and saying this is what you should invest in if you want impact investing, what we've done is we've actually worked with the industry, and so we have more than 130 products that are public equity, public debt, mutual funds, exchange traded funds, things that anyone who has an account of any worth can really invest in. Again, an ETF that might be screened for ESG, or that might be screened out. We have 130 different products of that kind that really anyone, even if they're not an accredited investor, can invest in. The other thing we've done to try to mainstream it is we've also tried to put together portfolios. I mean, so we saw that one of the challenges you had was that we would often get clients saying, yeah, I tried that sustainable investing stuff, Audrey, and it didn't work. And I said, well, what did you mean by that? What did you actually do? They'll say, oh yeah, back in 2008, I was all about windmills, and so I invested in a private equity fund, and that particular fund did terribly, and the rest of my portfolio did fine. And it's like saying, well, if you were a 6th grade science student, you wouldn't say, let's take, one anomalous thing and compare it to like a broad basket of things and say that that is somehow a controlled experiment, right? So what we've done is we've actually created model portfolios where with our financial advisors and their clients, you could say, okay, I want to give it a try. Let's one click go into a diversified portfolio of multiple products across equity or equity and debt that follows the global recommendations of the investment committee and also applies sustainability. And so now we're giving people the ability to say, I want to have the same global diversification, the same kind of multi-manager kind of risk diversification, and see how sustainability adds into that. When we actually did a study of 10,000 mutual funds comparing the sustainable strategies to the traditional strategies, we actually found that more often than not, the sustainable strategies had the same or slightly higher return. And also, more often than not, 64% of the time, they had the same or slightly lower volatility. So we actually think that we're trying to help people do it in a broad way. The last quick example that I'll give is with Morgan Stanley Equity Research. We've been working on fundamentally integrating environmental and social issues into the fundamental recommendations by our analysts to be neutral, overweight, or underweight. And what we've seen is we have seen our analysts changing calls. We've seen both analysts going back, looking at their spreadsheets again, saying, here's a couple of dozen factors that could be material impacting this company, and they're different for an automotive versus an extractives versus a tech firm. I'm actually, when I run the numbers again with those issues, it leads me to have a different conclusion. And we've had analysts upgrade and downgrade stocks as a result of re-looking at things with that additional impact data.
We are unfortunately out of time, but I think what this panel has demonstrated is that the sort of spectrum of capital is widening and it's been extremely well represented today. So could you join me in thanking Debra, Audrey, and Joshua?